Welcome to the New Wealth Wave podcast hosted by Dr. Joaquin Wallace. We're diving deep into the intricate layers of the 7-stage generational wealth model to offer invaluable insights on legacy building, wealth accumulation and preservation, and financial growth across generations. I'm Dr. Joaquin Wallace, and this is the New Wealth Wave podcast. Hey, future wealth builders, this is Dr. Joaquin Wallace. Welcome to another episode of the New Wealth Wave podcast. Today, we're on stages 4 and 5 of the 7-stage generational wealth model. If this is your first time tapping into the New Wealth Wave podcast, make sure you hit the subscribe button below. Today, we are on, again, stages 4 and 5, and Steve Selengut is going to lead the discussion. A brief bio on Mr. Selengut. He is an investment professional with over 50 years of experience in private portfolio management. Before selling his profitable business in 2023, he managed over 325 portfolios totaling $110 million in assets. Mr. Selengut developed proprietary investment concepts, including the working capital model, QDI plus PT, and smart cash. I'm sure he's going to give us some education on that as well. These concepts focus on generating consistent income through diversified, high-quality income-producing securities. His methodologies emphasize disciplined investing and income independence, especially for retirees, which is important, which is stages 5 of the 7-stage generational wealth model. I also have his book right here. He sent me a book. I happen to read the book as well. So if this is your first time tapping in again to the New Wealth Wave podcast, the New Wealth Wave podcast is focused on my 7-stage generational wealth model. So let's go over the model itself. There are 7 stages in 3 parts: the past, the present, and the future. Stage 1 is our internal and external ecosystem. Stage 2 is our financial genetic code, which focuses on financial trauma. Stage 3 is reprogramming our financial genetic code, which is financial healing. Stage 4 is financial edification, which we focus on financial inclusion as well as financial literacy. Stage 5 is financial well-being, which we're all trying to get to, that soft landing where we don't outlive our income. Stage 6 is generational knowledge. This is where we create our financial footprints to get to stage 7, which is generational wealth. Stephen, you had a chance to take a look at the model. What was your initial thoughts?
I think it's useful for a large percentage of the population to be able to look at things in the early stages, either to figure out where they came from and where they're going or where they want to go. Where are the traps? Where do you talk about keeping yourself out of debt? The debt associated with credit cards and things like that. Is there a place where a person really's got to take hold of that? That's where I am in 4 plus 5s. And at my age, I'm probably moving into the later stages as well. It's very important. Debt control and credit card management with the usurious rates we have on credit cards these days, they have to be really careful. And the younger they get involved in that, I think the better.
So when we talk about financial edification, which is financial literacy, this is kind of where we focus in that area because it's so important to tackle those topics, as you mentioned earlier. So before we get into the heavy lifting of the podcast itself, Stephen, tell us a fun fact about yourself.
I was thinking of that. I said, I'm really kind of boring, I guess. I'm focused. I'm certainly focused and energetic, but where I travel, I get a pair of socks. I try to find something that represents places I've traveled to. I have New Zealand stock with a kiwi on it, things of that nature. That's my quirk. Other than that, I'm just a boring wealth manager.
Well, as you mentioned, you're one of the few individuals that wrote a book and actually managed people's money. And many people don't do that. They have a lot of theories, but you have a lot of practical experience as well, which is so important. So thanks for the fun fact. So now let's get into the podcast itself. We typically start with 3 questions to all of our guests. The first question is, before becoming who you are, before you became this wealth manager, so to speak, wrote this book focused on financial education, financial literacy, retirement planning, where were you located on the model?
I think I started pretty high up. I was very fortunate, almost privileged, if you want to call it that. I grew up in a family where my father was successful, for the time, wealthy. He employed contractors. He was a builder developer. I didn't really know what he was doing until I got into college and we started talking about the streams of income you can develop in your businesses and stuff like that. But he was a vertically integrated operation where he had everything from the lumberyard that his subcontractors used to build houses, to building them, to building the roads in a development, rental properties within the development and so on. In addition to that, he'd finance the people. He would take back mortgages and he would provide the insurance coverage. So he had 3 or 4 different income streams coming in. Somehow that sunk into me. By the time I got out of college, I didn't experience the problems of getting that education in finance or in understanding not just the value of money, but how you make it happen and how you grow it and what to look for in a profession. I didn't want to be what he was or do what he did, but I knew I didn't really want to spend my whole life working for somebody else. I really started early trying to figure out how I could get my own gig going. I didn't know what it was going to be and no clue. Finally, it just happened. So I would say I started off close to that 4 level.
The next question is, you sold your business, a profitable business itself. What was your aha moment? I mean, something that triggered you to take this path that you're on today.
It was back when I was somewhere between the age of 25 and 30. I received a chunk of a portfolio. I didn't go to an Ivy League school like my brother did, so I had money left over from that. And I used to work in that lumberyard that my dad had. I used to drive trucks and deliver materials to people throughout the area. I made good money as a kid, and I put a lot of it away with him, and he invested it for me. So at age 25, I received a portfolio that I was said, it's yours now, don't lose it. And I took that to heart, studied hard, and learned stuff I didn't even touch on in college. And I looked at the markets and I saw how volatile they were, not as a bad thing, but as a good thing. If you look at enough charts, you see that they're all pretty much the same. Prices go up, they go down, they go back up again. But there's a general rising trend, particularly in equity securities. I discovered income purpose securities as well. I developed my own way of understanding the quality of the investments I make, how long they've been in business, how many different products do they have in their inventories, do they pay a dividend to their shareholders and owner of this business. I made all these things up and I lived with them and I started taking profits. I started trading early on and I figured out that I'm making a lot of money. And I was commuting to a job in New York. I was working in the pension investment department of a large life insurance company. And I learned a lot about portfolio management directly from the managers themselves. So I got to the point where portfolio design was easy for me. Portfolio strategy was different for them. And I found out why it was different. I put that information to use in my own portfolio. And finally, I figured out I really don't need to commute to New York and buy 3-piece suits. All I need to do is talk to my friend, the dentist, and my other friend owned a successful restaurant in Long Island and a few others and say, hey, look at this. I started this 5 years ago. It's gone from here, added a 0 to here. Look at the income it's generating. What do you say I do that for you? You can become my first clients. And they did. And the rest is history. I went from less than 100,000 of other people's money under management to 110 million. We had a good time. It was fun. And that's the other thing. People need to make sure they're having a good time doing what they're doing. So the thing I did was I realized that I was making more money than I was making at work. So I could afford to take the time off, develop my own business, and not go backwards. I had a product that I could visually present to people that worked. And I, of course, had to learn how to market it myself and who do you contact? In those days, there were no podcasts. I got on a couple radio shows. We went to conferences and set up booths all over the East Coast to spread the word. So that was my first aha moment where I said, okay, I don't need to work for them anymore. I can do it by myself and I can start my own business. Then the second aha moment was, how am I going to get out of this and continue to live the way I'm living without working that much and with all those people? That aha moment was when I realized that even though I wasn't going to get all the money for the business in one chunk, my portfolio had grown to the extent that I could live on the income my portfolio was producing and wait the 18 months until I got to the second 45% of my payout without really dipping into capital at all. I could afford to take the deal without going backwards financially. So those are the 2 aha moments I had.
Thanks for sharing that. You mentioned earlier the 7-stage generational wealth model. We're focusing on not outliving our income, obviously, and financial health is financial wealth. So Future Wealth Builders, we're excited to have Steve Selengut, author of Retirement Money Secrets, a Financial Insider's Guide to Income Independence, on our podcast today. You can find us on Apple, YouTube, Spotify, and all of the major social media platforms. Make sure that you subscribe. You can get more information about the New Wealth Wave podcast here, other content that we do have, and hopefully you will take some of the information that Mr. Selengut would provide for us today and use it for your life Therefore, you could be like Stephen as well one day, and you can retire and have no worries in the world. So let's get with our first question. How can understanding and reprogramming harmful financial habits, as emphasized in my 7-stage generational wealth model, empower individuals to make more efficient investment decisions?
There are so many fine lines in the investing world. The first one, and you mentioned it before, financial literacy. How many people do you think come out and look inside their 401k and know what's a stock and what's a bond? What's the difference between a stock and bond? Do they know that stocks represent ownership in a company and that company goes out of business, that the stock goes to zero? Consequently, that should make them think, well, I better not put too much in any one thing. I better spread it out and diversify. Do they know that income securities means the debt of a corporation in one form or another, or of a government entity? Financial literacy is very important. Knowing the basic rules of investing, our educational system. You get out of high school, you're lucky if you know how to balance a checkbook, much less know the difference of those things I just mentioned, or have enough understanding of the economy to make decisions of whether you should be buying or selling securities and why. So getting yourself an education, and of course, I'm going to tell you, that book behind me, Retirement Money Secrets, will give you a lot of information about how you should think about investing, what it is, what are these fine points, why is it important to take profits, why is it important to diversify and get some kind of income from everything you invest in so you can either reinvest it or spend it. What should you focus on when you're investing? Most newscasters, blogs, podcasts, and social media, whatever, the only thing you want to hear about is whether the market's up or down. Up is good and down is bad, no matter what. But nobody ever talks about investing for income, investing so that when you're ready to retire, you'll have enough money to say goodbye. You can't do that just with growth of market value. The cover of the book has a statement on it. It says, market value fuels the ego, income fuels the yacht. At some point, you have to start turning the profits, the green color on your portfolio statements, into additional capital that generates more income. You want to start seeing your capital and income production growing every quarter, every year. When you get into your 60s, when you can say, hey, I can get full pension with early retirement, you can go ahead and do it because you got your own pension as well. You know, you created it yourself. So those are the types of things, the subtleties of investing, the questions you should ask of an investment advisor. If you're a successful businessman or a successful employee of a successful company, and you've got these 6-figure bonuses coming in every year and a nice salary, and you don't have the time to do it yourself, you have to trust a professional to do it for you. I did that for people for all these years. They knew that my emphasis was going to be what I just said. I am going to create you a growing stream of income and a growing depth and breadth of capital, a diversified portfolio of many different things, so that if one thing went out of business, it wouldn't bother you, so that if you got fired or quit, you'd have enough income to see you through. That's my job. My job is not to make your account statement look pretty because the market value is this high. My job is to give you the income to live the way you want to live. As an investor, you have to look your advisor in the eye and say, I don't care if my statement is pretty. I want my statement to produce income.
So, Stephen, what is income-focused investing, and how would this mindset help secure our financial future?
It's that shift I was alluding to just before. It's when you say, hey, Frank, I'm going to give you all my money to manage for me, and this is what I want. You have this thing called the 4% rule where most retirees, and I'm going to retire early, most retirees are going to have to use 4% of their market value every year in retirement. And I know you want to keep growing that market value so that that's a nice number. But you also get paid on the growth in that market value. So in order to be certain that you are working in my best interest and not just your own, I want you to make money. I want to make money also. So what I want you to assure me is that A, my portfolio will produce more than 4% in income, and B, that it will also produce more than your fee in realized capital gains. If you do those two things, both of us will be very happy. You have to change the mindset of your investment advisor from growing that enormous chunk of market value and patting you on the back. Wow, look how rich you are. And not on the other side saying, look how rich I am. And saying, patting yourselves both on the back. Thanks, Frank. You've made all the money I need to live on. And you've taken enough profits on my portfolio that I know you're working for me and not just for you.
Great example, Stephen. I have another question for you. What common mistakes do families make in wealth preservation and transfer areas, and how can they overcome them to create a legacy?
That's a really good one. And that's something I'm dealing with now. How do we spend as much as we want and go where we want to go, but still leave a significant amount for the children and grandchildren and some friends and other relatives, perhaps, if there's enough to go around? To me, it always comes back to that income question, because the more income they have, the more of those things you can get organized to take care of. The basic principles of investing, I guess a lot of people say, well, that's just investments 101, right? Those are the things you need to know to get started. But no matter how wealthy you get, the quality of what's inside your portfolio is still the primary thing you have to think about. This morning, a guy wanted me to look at his portfolio, and of the 6 or 7 securities he had shown me, most of them were very new issues that were paying a lot of income, but they hadn't been in business long enough for my taste to be safe. The way you determine quality of investment is how long the company's been in business. Does it pay dividends to its owners? Is its product line diversified enough so it doesn't become that buggy whip manufacturer that all of a sudden has no buggies to provide whips for because we've got automobiles? You look at things like the price of the stock compared with its earnings, the PE ratio. You look at things like its debt to equity. How much in debt is it? So there are technical and fundamental things you look at. Quality can also be a function of, is all of your investing just in the United States? Do you have too much in the energy sector and nothing in healthcare? Are you properly diversified in many different ways? Those quality tests are always important, no matter how wealthy you get. In fact, one of the definitions of wealth that I've always got a kick out of is there's only 2 times in your investment life that you can't afford to take risk and that you don't need to take risk. That's when you're just getting started and when you've achieved wealth. There's no reason for you to take undue risks. I have family members who are quite wealthy, and one of them's invested totally in treasury bills. He doesn't care that he's not making a lot of money. He knows that that money is going to pass on to his heirs. It's going to be solid. It's not going to go bust. At least we hope not.
That's some great information. So many of our listeners probably don't know what the definition of new issues are. So in a real quick sentence, could you give a definition of what new issues are?
A new issue, or an IPO, initial public offering, is when a company goes public for the first time. You've seen all the big name companies become very successful as privately held. Then they turn all this wealth they've accumulated into stock that the general public can buy. And when they do this IPO, we all now own part of their company. Well, there's no guarantee that the company is going to continue to be just as successful as it was. Then you've got the problems of regulation that'll come in once you become a public company. Sometimes you can't operate quite the way you used to when you were a private company. And maybe the shareholders aren't going to like it if you're not paying them any dividends and your top 5 senior officers are making $20 million a year in salary. There's just a lot of risk associated with a newer business. NVIDIA, for example, is a recent new issue in a whole new industry. In AI, how many other new issues are in that same area right now? And are they all going to be as successful in the stock market as NVIDIA was? And what happens when a new business is coming to market? What happened in 2020 where we were very high in the market before COVID? That's when companies like to go public, when the market's hot. When the market's high, that's when they want to get out there because they get the highest amount of money for their shares. And what if some of them just did that and all of a sudden the country shuts down because of COVID? Those companies didn't make it. And those people who bought that initial public offering, that new issue, they got hurt. So new issues are a very speculative thing, just like buying gold and silver. You can't go into the grocery store or the pharmacy and put that gold brick you have on a counter and say, here, I need my prescription filled. They're not going to give you a change of a gold brick. You need money. So a lot of speculative, illiquid type investing, like new issues. Those are things you got to know about and avoid. You want to be able to look at it. And if you need to trade it in modern technology, you want to be able to push a button that says sell and sell it for a price that you know exactly what that price is going to be. If you can't do that, it's not a liquid security. It's not something that you should be considering as an investment.
Thanks for that definition there, Steve. Another question for you. You talk about in your book, what are the 4 great financial risk minimizers?
Financial risk means the probability or possibility that the company or entity that issues a bond, for example, would go out of business or default on the payment. That's financial risk. Most people today hear about market risk. Market risk is price of the security could go down from where it is now. And that's really the normal nature of things. It's really not a risk. It's a known entity. Every security, anything traded in the market is subject to changes in price, upward and downward. It's the financial risk that's really the significant thing. And that's the thing we try to protect ourselves from and minimize. There are 4 ways of minimizing financial risk. Are to develop your own ways of determining the quality of the type of security you're going into, whether it's real estate or a commodity of some kind or stock market, bonds or whatever. Determine the quality. There are ratings on bonds, for example. You can look at PE ratios and other things with stocks and whether they're going to pay a dividend to determine the quality. The second risk minimizer is diversification. And we haven't really spoken about that yet. Diversification means ideally, nothing would ever represent more than or even close to 5% of your entire portfolio of investments. No matter how much you love the employer you're working for, you don't want the stock in that company make up more than 5% of your total investment portfolio. The reasoning is simple. Stuff happens. Businesses go bust. They do go under. Or you can happen on a situation like Enron. Do you remember Enron?
Absolutely.
Okay. Well, Enron was a situation where a company was blown up fraudulently. Everybody was to believe that they were actually an A-rated company. They paid dividends. They looked great. They said they were profitable. They had all this stuff going for them. And all of a sudden, it turned out to be a fraud and they went to zero. Who knew? And it was years. It wasn't just a matter of a couple of years. It was several years that it all happened. So you got to diversify for another reason. There's defensive diversification and there's offensive diversification. Offensive is the one I like. Defenses mean you don't have anything more than 5%. If you get it as low as 4% or 3%, all the better. What I do is I use these securities called closed-end funds, which are trust vehicles. They're very high income producing. The content is the same as in ETFs, mutual funds, and the stock market. It's the same securities. It's a different package. It's a package where the focus is income production, not growth in market value. So it fits my model very well. You can find any possible security you're interested in, from real estate to healthcare to every kind of stock in the stock marketplace, in these closed-end funds. And if you own enough of them, and I own a lot of them, you'll have your fingers in every economic pie. If things are going well in Europe, you'll benefit from it. If the healthcare industry discovers a cure for cancer and all healthcare securities go up, you're going to benefit from it. You're never going to be out of anything that happens good. On the other hand, you're never going to be out of anything that happens that makes securities go down, which is a good thing too, because when a high quality company goes down in price, it's a better opportunity to buy it.
Absolutely. It's important that those who are looking for a financial planner or a financial advisor ask these questions. Know what open-end funds are. Know what closed-end funds is. Know what systemic is and non-systemic, because those are extremely important when you're looking at investing your money. Oftentimes, we find individuals who are investing who are not really doing their due diligence. And as you mentioned earlier, it's important to work with an advisor or a planner who has a track record. And again, you can look on brokercheck.com. You can see exactly what these individuals do. But for the most part, it's important not to try to do it on your own. It's important to get with individuals who are experienced, who have a track record, have an understanding. This is kind of high level for some people. We can always go into that. But for the most part itself, understanding systemic versus non-systemic, understanding, what does drive the market. I always say when you look at diversification or you look at purchase price, risk, market, all these things you have to take into account for systemic risk. Future Wealth Builders, we're excited to have Steve Selengut, author of Retirement Money Secrets, a financial insider's guide to income independence on our podcast this afternoon. You can find us again on Apple, YouTube, Spotify, and all of the major social media platforms. So another question for you. When you mention managing a portfolio is similar to running a department store, what do you mean by that?
That's where I'd like to see us going. When people realize that when they're in the investment markets, there's no stability to prices. The prices are going to always be ebbing and flowing depending on so many factors: health, economy, politics, everything affects the market. So you have to get into a different mindset to handle that. Unfortunately, most people have been convinced, brainwashed even, that they want to get what's hot. Give me one that's going to go up. Which one's going up? I want to get in on that. I want to get in the bottom floor of AI, so I'm going to put all my money in AI. They just go about it uninformed, unaware of the risks involved in just following some fad or a thought process that doesn't understand the quality, diversification, income, and profit-taking risk minimizers that we were talking about. They don't get the education they need to take care of the investment part of their finances. It's almost to the point where I would tell a child or a grandchild, right now you're getting 4% in the bank and you're not going to make any mistakes, but just put it there until I can find you an advisor that's going to help you. It's really difficult in the current environment to identify a process that works instead of a person who thinks, because of who you are, what your level of expense needs are, they can push a button and put you into a model portfolio of what's going to make that happen for you. And it's primarily going to be just in the stock market. And there's going to be companies there that you've never heard of. I've seen portfolios where a young person with $30,000 had a model portfolio. They had like 1 share, 2 shares of some things. They had fractional shares, less than 1 share of several different securities. How is that going to work in the long run? Almost none of them pay any dividends. So the only thing they can hope is that the person will keep sending $1,000 out of his monthly paycheck, and they'll add it to the very same securities each time, which in itself has problems. So I think we're in a scary time in the stock market right now because of that focus. There's no doubt in my mind that sometime in the next few years, this euphoria that we're feeling now at all-time high in the stock market is going to turn into another correction. There has never been a rally that hasn't succumbed to a correction, and vice versa. It's going to happen. And who's prepared for it? You're not prepared for it if you're just holding on to things and watching the big green numbers on your portfolio statement get bigger. The only way you're going to prepare for it is you're taking your profits, putting it back into your portfolio in different things that are paying income, because with an income portfolio, it doesn't matter when that correction comes. The income is not going to be affected, but the profits are going to disappear. I don't know of a solution. I'd like to think that an education and an income-focused scenario would be a big help for a lot of people, and we're working on it.
That's why I always say financial literacy is not a linear process. It's a holistic process. It's just not about budgets and things of that nature. So, Stephen, what do you mean by the phrase on the cover of your book? Market value fuels the ego, income fuels the yacht.
In the simplest of terms, when you look at your portfolio and you see how big it is, let's say it's 7 figures, your chest gets all puffed. It's the first time it's been over 7 figures in this current rally. You say, wow, I've really made it now. I'm worth over $1 million. You go to the restaurant and you say, I need a table. And the restaurant says, I'm sorry, sir, I don't have it. But I'm worth over $1 million. I've got $1 million. We don't have a table for you, sir. Well, here's $5. You're not going to get a table for $5. Maybe you gave me 100, I might get you a table. But the thing of it is, the market value of your portfolio, it's not going to buy airline tickets. It's not going to feed your family unless you take those profits and turn them into some kind of cash. But you can take that same 7 figures, and if you have it in securities generating 10% a year, closed-end funds are doing right now, then you've got $100,000 of income coming in every year, between $8,000 and $9,000 a month, that you can go bribe the guys at the desk in a restaurant with, or you can go buy whatever you want to buy. You can rent a boat and take it out in the harbor for a weekend. That's the difference. That wealth sitting there in a portfolio with no income coming in doesn't do a damn thing for you, but you can make it work for you. That's one of the things you have to tell your advisor. Hey, Jack, I need income. It's a pretty number, but it's not doing anything for me. I got kids going to college next year. I need $50,000 for tuition. This portfolio is generating $5,000. It should be generating $100,000. I got a kid that needs $50,000. He's going to have to take a loan because your portfolio isn't generating any income for me. That's what that statement is saying. Income pays the bills.
You got to change your mindset. That's a great point. I got a couple of final questions for you. One is, how can individuals balance growth, security, and preservation to achieve lasting financial stability and build long-term wealth?
The one thing about the income portfolio, which is central to doing all those things you just said, is that if you reinvest as much as 30% of that income, your market value is going to grow too, because you're buying securities with it that are income focused. But under the right circumstances, those securities are going to go up in price as well. My portfolios, which are 70%, 65% focused on income purpose securities, hit an all-time high last month. It was close to an all-time high day before yesterday when all the dividends hit the account before I took out a chunk of money for taxes. It still gets to those all-time high levels, but while paying the income and while you're reinvesting it, it's a slower process of making that number bigger, but it can be done. And that's all four of the things you mentioned just now. Income investing, quality securities, diversified portfolios, taking the profits, builds the wealth, builds the income at the same time. The focus on Wall Street today is to build the wealth number. They don't pay any attention to the income number. There's got to be a balance of it. That's what we're missing.
And that's stage 5 of the generational wealth model. We talk about financial well-being, not outliving your income. Financial health is financial wealth. So all of those things that you're speaking about, and that's why it was so important to bring you on, because we're talking about stage 4, which is financial edification. But most importantly, stage 5 is just financial well-being. That's what we're all trying to get to. We're trying to get to a place where we have that soft landing. We're able to do the things that we like to do. We have no financial stress because, again, financial health is financial wealth, and we're not outliving our income. So final question for you. What do you want the listeners to take away from this particular podcast?
I think we've hammered it home pretty well that they have to start focusing more on the income generated by high quality, diversified portfolio. If they looked at their portfolio statements and found the number that said, this is the percent of income, let's say they had a $300,000 portfolio, and they look at the income being generated and see $1,700 a year, or even $5,000 a year. That's between 1.5% and 2%. Portfolios can easily be structured to generate in the 6% area, even without closed-end funds. With closed-end funds, they can be structured to generate far more than that. Take a look and see what the income picture is for your portfolio, whether you're doing it yourself or someone else is managing it. Know that you can do better. Know that you can get it up to a better level, and then find somebody who'll do that for you or learn how to do it yourself.
Great point. So this is an opportunity for you to tell the listeners how they can get in contact with you.
I think the starting point is to get a copy of that book or an Audible book, and it's available in electronic format as well. It's probably worth the investment because of what it'll teach you about how you can generate more income in your portfolios and how you can do it safely. I have a website called theincomecoach.net where they can get in touch and look at the services I have. I also have a couple of Facebook groups about closed-end funds. We're developing a community. It's a teaching community. We're going to offer all the selection universes for using these types of investments as part of it, and various types of Q&As on individual subjects, like a whole course on how to determine the quality of securities, how to diversify properly, things like that. All of the things that I cover in the book will be covered in separate, easy to get through packages. That's what's on the agenda now. That's what we're doing.
Make sure you subscribe. If you want to pick up the book, I have one right here. There it is. So make sure you pick up a book. We'd like to thank Mr. Steven Selengut for coming on the New Wealth Way podcast on behalf of my producer, Ray Haycraft, and myself. As we always say, generational wealth begins with generational knowledge. And we'll see you on the next episode of the New Wealth Way podcast.
Thank you for joining us on the New Wealth Way podcast, hosted by Dr. Joaquin Wallace. Our show is edited and produced by Ray Haycraft. To dive deeper into the world of financial wisdom and learn how to create your financial footprints, head to our website at www.drjwallace.com. For more updates and exclusive content, connect with us on social media by searching Dr. Joaquin Wallace. And if you have questions and comments, feel free to email us at thenewwealthwaypodcast@gmail.com. Remember, generational wealth begins with generational knowledge. And as always, thanks for listening. The content presented in this podcast is strictly for educational purposes and should not be taken as investment advice. The views and opinions expressed by our guests may not necessarily reflect those of the New Wealth Way podcast and its host or producers. Listeners are urged to exercise discretion and judgment before making any financial or investment decisions. Always consult with a financial professional or advisor before taking any action based on the content of this podcast. If you're enjoying the New Wealth Way podcast, we appreciate if you leave us a review. We're always open to topic suggestions and guest recommendations. Feel free to reach out to us directly with your thoughts and feedback. Thank you for tuning in, and we'll see you next time on the New Wealth Way podcast.